Hello guys, in this video we will talk about the evolution of banks in India. Before going into the video we have to split up into two parts. One is before independence and another one is after independence. First we have to see the evolution of banks before independence. The evolution of banks under British rule in India is a fascinating tale of economic growth, political influence, and cultural exchange. Banks played a critical role in shaping the colonial economy of India, and their influence is still evident in the country's financial system today. In this essay, we will explore the history of banks in colonial India and their impact on the country's economy and society. The earliest banks in India were established in the 18th century by British merchants and traders who came to India to exploit its rich resources. The Bank of Hindustan was established in 1770, and other banks soon followed, including the General Bank of India, Bank of Bengal, and Bank of Bombay. These banks primarily served the needs of British merchants, traders, and colonial officials. In 1806, the Bank of Calcutta was established, which later became the Bank of Bengal. This was the first bank in India that had the authority to issue notes, and it played a crucial role in the development of the colonial economy. The Bank of Bengal was followed by the establishment of the Bank of Bombay in 1840 and the Bank of Madras in 1843. During this period, the banking system in India was primarily controlled by the British, and banks were established to serve their interests. The banks played a critical role in financing the trade between India and Britain and in facilitating the transfer of funds between the two countries. In 1861, the Paper Currency Act was introduced, which gave the government the authority to issue paper currency in India. This marked the beginning of the government's involvement in the banking sector. In 1921, the Imperial Bank of India was established, which was a private bank that served as the Central Bank of India. The Imperial Bank of India later became the State Bank of India, SBI, in 1955 after it was nationalized. During the early 20th century, the Indian economy experienced significant growth, and banks played a crucial role in facilitating this growth. Banks provided financing to businesses and entrepreneurs, and they helped to create a stable financial system that supported economic growth. Banks also played a critical role in the development of infrastructure, including the construction of railways, roads, and ports. However, the banks under British rule also faced several challenges. The banking sector was primarily controlled by the British, and Indian businessmen and entrepreneurs faced discrimination in accessing credit. This led to the establishment of several Indian-owned banks, including the Allahabad Bank and the Punjab National Bank, which provided financial services to Indian businesses and entrepreneurs. Another significant challenge was the impact of World War II on the Indian economy. The war disrupted trade, and the demand for Indian goods decreased, which had a severe impact on the country's economy. Banks played a critical role in providing financial support to the government during this period. The evolution of banks under British rule in India was a fascinating period in the country's history. Banks played a crucial role in shaping the colonial economy and in facilitating economic growth. However, the banking sector was primarily controlled by the British, and Indian businessmen and entrepreneurs faced discrimination in accessing credit. Despite these challenges, the banks under British rule played a critical role in creating a stable financial system that supported economic growth, and their influence is still evident in India's financial system today. Now we have to see that after independence. With India's independence in 1947, the banking sector underwent significant changes. The Banking Regulation Act of 1949 was introduced to regulate the banking sector and establish the Reserve Bank of India (RBI) as the central bank of the country. The RBI was given the authority to issue currency and regulate the country's monetary policy. The Act also gave the RBI the power to supervise and control banks and financial institutions in India. In the 1950s and 1960s, as India's economy underwent significant changes as the government pursued a policy of economic planning and development. The government's focus was on industrialization and creating a self-reliant economy. In 1969, the government nationalized 14 major commercial banks to promote financial inclusion and control the banking sector's activities. This move was seen as a way to make banking services available to the masses and to promote economic growth. The nationalization of banks was done in two phases. The first phase took place in 1969 when 14 major commercial banks were nationalized, including the State Bank of India, and Bank of Baroda. The second phase took place in 1980 when 6 more banks were nationalized, including the Central Bank of India, Indian Bank, and Punjab and Sindh Bank. The nationalization of banks had several positive impacts on the Indian economy. It led to an increase in the number of bank branches, particularly in rural areas, which helped to promote financial inclusion. The nationalized banks were also mandated to provide credit to priority sectors such as agriculture, small-scale industries, and exports, which helped to promote economic growth and development. In the 1990s, India introduced economic liberalization policies, which led to significant changes in the banking sector. The government allowed private sector banks to enter the market, and foreign banks were also allowed to set up operations in India. This move led to increased competition in the banking sector and the introduction of new banking products and services. In recent years, the Indian banking sector has witnessed significant changes. The introduction of technology has revolutionized the way banks operate, and the digital banking ecosystem has grown exponentially. The RBI has taken several initiatives to promote financial inclusion and digital banking. The Jan Dhan Yojana, launched in 2014, aimed to provide banking services to the unbanked population. The Unified Payment Interface, UPI, launched in 2016, has made digital payments easy and accessible for all. In conclusion, the evolution of banks in independent India has been marked by significant changes and growth. The nationalization of banks in 1969 and 1980 led to increased financial inclusion and economic growth. The liberalization of the economy in the 1990s led to increased competition in the banking sector and the introduction of new banking products and services. In recent years, technology has revolutionized the banking sector, and the digital banking ecosystem has grown exponentially. The Indian banking sector is poised for significant growth in the future, and it will continue to play a critical role in promoting economic growth and development in the country. Okay guys, hope this video helpful to you, and see you in the next video. Bye bye from Information School.